Most traders don't lose money because their risk-reward is bad. They lose money because they can't stick to it. They talk about 1 to 3, 1 to 5, even 1 to 10 like it's a magic formula. They draw perfect levels. They calculate the math. They convince themselves that if the ratio is good enough, the profits are inevitable. And then, trade after trade, they break their own rules. They cut winners early. They move stops. They hesitate. They revenge trade. And when the account bleeds, they don't question their discipline. They question the ratio. 95% of traders are obsessed with risk-reward. The other 5 barely mention it. Same markets, same charts, same ratios available to everyone. Completely different results. The 95% believe trading is a math problem. If the numbers are right, the outcome should follow. When it doesn't, they assume something is missing. A better entry, a tighter stop, a bigger target, a cleaner setup. They keep adjusting the math, convinced the solution lives there. The 5% see it differently. They understand something uncomfortable. Risk-reward doesn't make you profitable. Discipline does. Risk-reward only works if you can execute it exactly as planned, again and again, especially when it feels wrong to do so. In this video, we're going to break a belief most traders never question. Why chasing perfect risk-reward ratios keeps you stuck. Why discipline beats even the best-looking setups. And why the traders who last don't win because their ratios are better, but because their behavior is. Part 2. Why knowing the math still isn't enough. Most traders think they're one tweak away, one better ratio, one cleaner entry, one adjustment to the stop. They tell themselves they already understand risk management. They just need to optimize it. That belief keeps them trapped. It's not that traders don't know risk-reward matters. They know it, intellectually. They've heard it 1,000 times. Risk more than you make, you lose. Risk less than you make, you win. Simple. On paper. In reality, knowing the math doesn't mean you can live with it when money is on the line. Take the trader who prides himself on discipline. He only takes trades with a minimum 1 to 4 risk-reward. Anything less, and he skips it. He waits for perfect alignment. When he finally enters, the trade starts working. Price moves in his favor, then pulls back. Nothing invalidated. Still within the plan, but the pullback feels uncomfortable. Unrealized profit starts shrinking. Doubt creeps in. He closes early. Small win. Next trade, he takes a loss. Now the math is broken. He tells himself the ratio doesn't work. Another time, price moves against him immediately. The stop is close. Too close. He nudges it a bit wider. Just this once. It comes back. Relief. The habit is reinforced. Slowly. Quietly. Discipline erodes. But on his journal, everything looks fine. The ratios were good. The problem must be the market. Now look at a different trader. Same market. Same time frame. Average risk-reward. Nothing impressive. Sometimes 1 to 2. Sometimes a bit better. No obsession with perfection. What's different is what happens after entry. Once he's in, the decision-making stops. The stop stays where it is. The target stays where it is. Win or lose, the trade plays out exactly as planned. Over a week, his results don't look exciting. Over a month, they look steady. Over a year, they compound. Not because his risk-reward is superior, but because it's actually real. It exists in execution, not just intention. This is where most traders get confused. They compare planned risk-reward, not realized risk-reward. They measure what they intended to do, not what they actually did. And those two are rarely the same. The difference between the trader who survives and the one who keeps restarting isn't the ratio on the chart. It's whether that ratio survives contact with emotion. Part 3. The real reason. Risk-reward breaks down in live trading. So why does this keep happening? Why do traders cling so hard to risk-reward ratios, even when their results clearly show that execution keeps breaking down? Because risk-reward offers something discipline never does. Comfort. A ratio feels objective, clean, mathematical. It gives the illusion of control in an environment that has none. When you say this trade is 1 to 4, it feels like you've already done the hard part. The numbers make it feel safe, almost guaranteed, as if the market now owes you that outcome. Discipline, on the other hand, offers no such reassurance. Discipline doesn't promise anything. It just demands that you behave the same way, whether the trade wins or loses. This is the first trap. Traders use risk-reward as a shield against uncertainty. If the math is good, they tell themselves, the rest should take care of itself. But markets don't reward good math. They reward consistency. And consistency is behavioral, not numerical. The second trap is outcome fantasy. Large risk-reward ratios invite imagination. Traders don't just see the setup, they see the profit. They picture the runner. They mentally spend the win before it happens. Then, reality intervenes. Price pulls back. Time passes. The trade doesn't move the way it's supposed to. Suddenly, the fantasy is under threat. That's when discipline collapses. Profits are taken early. Stops are adjusted. Trades are interfered with, all in the name of protecting what was never guaranteed in the first place. Then, there's the emotional cost of discipline itself. Holding a trade exactly as planned is uncomfortable. Sitting through drawdown feels irresponsible, even when it isn't. Doing nothing while the market moves triggers anxiety. Taking a clean loss without adjustment feels like failure. Discipline asks you to tolerate discomfort without immediate reward. Risk-reward doesn't. It lets you feel productive without paying that emotional price. Another problem is selective discipline. Most traders believe they're disciplined because they follow rules when things are going well. They size correctly after a win. They wait patiently when confidence is high. But discipline isn't tested on good days. It's tested after losses, after boredom, after frustration. That's when rules start bending. That's when just this once shows up. Risk-reward looks perfect on the chart, but behavior changes under pressure, and the edge disappears. This is the part most traders don't want to accept. The breakdown isn't happening at the level of strategy. It's happening at the level of self-control. The 5% don't have some superior understanding of ratios. They simply follow their rules when it's emotionally inconvenient to do so. They accept that discipline is the real work, and risk-reward is just a supporting tool. Until that clicks, traders keep searching for better numbers, better setups, better maths. Not because those things don't matter, but because they're easier to chase than behavioral consistency. And as long as discipline remains optional, no risk-reward ratio, no matter how good it looks, will ever save the account. Part 4. When discipline becomes the real edge. This is where the shift happens. Not in the numbers, but in the way you see your job as a trader. The question stops being, is this risk-reward good enough? And becomes something far less exciting and far more important. Can I execute this exactly as planned without interference? Risk-reward is not useless. It matters, but it's not the edge. It's a tool, a structure. On its own, it does nothing. A perfectly planned 1 to 5 means nothing if you keep cutting winners at 1 to 1. A textbook setup is worthless if you hesitate, second-guess, or override your rules once money is on the line. An average risk-reward, executed with absolute consistency, will outperform a perfect one that only exists on paper. This is what discipline actually looks like in real trading. Taking trades you don't feel excited about. Holding positions when you want relief. Letting winners breathe, even when your instincts are screaming to close. Taking losses cleanly, without adjusting, without revenge, without rewriting the story in your head, and then doing it again. The same way, tomorrow, next week, next month. The traders who last aren't chasing better ratios. They're building trust with themselves. They know that once they enter a trade, they will behave the same way every single time. That trust removes hesitation. It removes internal conflict. And that stability allows even modest edges to compound. At some point, the identity changes. You stop seeing yourself as a trader hunting big wins and start seeing yourself as someone who executes rules. Your confidence no longer comes from how good the setup looks, but from knowing. You'll follow your process regardless of outcome. Wins don't inflate you. Losses don't break you. They're just part of the repetition. And here's the boring truth most people don't want to hear. Profitable trading isn't exciting. There's no constant optimization, no endless tweaking, no obsession with squeezing out a slightly better ratio. It's repetitive, quiet, sometimes dull, long periods of waiting, interrupted by moments of simple execution. The excitement fades, and what replaces it is consistency. So the choice is simple. Even if it isn't easy, you can keep chasing better numbers, believing the next ratio will fix everything, or you can do the unglamorous work of mastering your behavior and letting the math work over time. Discipline doesn't look impressive. It doesn't feel clever, but it's the reason some traders stay in the game long enough for risk-reward to matter at all. If this way of thinking resonates, keep following the channel, as we'll be sharing more insights, trading stories, and trading motivation tips in future videos.